Happy Monday. Back at it. Richard, yields and the tax cutting that Congress is doing, this was supposed to stimulate the market, but this Moody's ratings cut, if nothing else, raises the specter of fiscal issues pushing the other way. So what should investors do here, and why do you think European quality is part of the answer?
So John, great to be with you. I think, look, the thing that hasn't gotten, I think, enough attention has been yet another downgrade of the U.S. Treasury, right? That we are no longer investment grade. This started more than a decade ago. It's continuing. There's nothing good to say about that. And I think even though day to day, the 10-year may trade in one direction or another, the reality is for like the past 14 years, the Treasury is sold at a premium yield, in other words, a risk premium relative to AAA rated sovereign debt. So we're already being penalized as a nation. It's clear that what's going on right now is not going to help that, whether it's a downgrade, whether what's going on in Washington or anything like that. On the stock side, I think you're absolutely right. The quality, I think one of the things that we have to come to grips with here, tariffs, no tariffs, downgrade, no downgrade, the profit cycle in the United States is peaking. That would happen no matter, regardless of what's going on in Washington. And I think that's the most important investment issue right now, because it really argues that people should be looking at quality. They should be looking at defensiveness. They should be looking at cash flows. And if you want quality, the cheapest quality in the world is in Europe right now, and it's doing very well, and still nobody cares. So I think there's a tremendous opportunity there.
Okay, we'll talk more about that. But Ryan, first, you were bullish through those dark market days in April. You say the trade woes are behind us now, but there are still significant tariffs on either way, and some fear there's going to be a reckoning with stretched consumers. Why shouldn't they worry?
Yeah, John, thanks for having me back. Happy Monday, everyone. I would think I was on with you exactly a month ago, on April 22nd. So about 20 trading days ago. The S&P's been down only 3 of them. And when you think about what's going on, I mean, listen, all these worries and concerns are real. We're not ignoring everything that's out there, but are we listening to what the market's doing, right? The previous 27 trading days, the S&P's up close to 20%. Okay, what does that mean? That's not a bear market rally. That's not a short cover rally. Times we saw that much strength, John, in 1 month, off the 74 lows, off the 82 lows, off the 2009 lows, off the 2020 lows, and right now. Okay. I mean, I get it, right? All these worries, but all this over-the-top negativity. Yes, earnings probably are not as strong as they were going to be at the start of the year. We get it, right? But all the people thinking that how bad everything's going to be, we think we're going to avoid all this negativity, and that is why those markets come back like it has. And I will say, we like Europe also. We like Europe. We like developed international. We've got some European exposure in the money we run for our Carson partners, but we clearly are still overweight equities and have a good deal of U.S. large caps in there as well. So we still think U.S. is going to play catch up with the rest of the globe here the rest of this year, John.
Okay, so Richard, investors still love risk in this market, even if Moody's doesn't. You spotlight the biggest tech stocks here, ex-NVIDIA, as being unworthy of their multiples. Tell me more.
Yeah, so John, I think, we can argue all day long whether the Magnificent Seven are magnificent companies, but the reality is they're not unique. And by that, I mean, if you look at the median forecasted growth rate for the Magnificent Six, take out NVIDIA, because NVIDIA skews the data a little bit. You look at the forecasted earnings for the Magnificent Six, they're supposed to be up about 8% over the next 12 months. Their earnings are supposed to be up about 8% over the next 12 months. The median company in the remaining 493, the S&P, is supposed to be up 9%. Their earnings are supposed to be up 9%. So the Magnificent Six of the 7 are actually inferior growers relative to the remaining of the market. So the question has to be like, what's so special about these companies? And I would argue the answer is nothing. They're clearly not going to grow faster. They're much more expensive. They don't offer dividend yields. There's a clear differentiation starting to appear here. And I think that's very important. The other thing I would just say, and just to push back on what Ryan said a second ago, you look at 82, you look at 90, you look at all these other periods, 2009, you would not find individual investors carrying a beta in their portfolios of 1.7, which is where we have right now. We have credit spreads incredibly narrow, not wide. We have individual investors taking risks like they've never taken before. That's a little bit different from, I would say, from the periods that Ryan is talking about.